Good, everybody. Okay, welcome back, both our in-person audience and our virtual audience. And so now we're going to start the second part of the program. We're going to be talking about digital currencies, and we're going to lead off with central bank digital currency. Really pleased to have from the IMF Deputy Director, Arif Ismail. Arif formerly was head of fintech at South African Reserve Bank. He has deep experience in cryptocurrency and digital currency, and has been working diligently on a project for the IMF to try and understand what the central bank digital currency is. And I think it's not well understood, but I know that Arif does understand it. And so we're inviting him to give a presentation, and then we'll have a discussion about central bank digital currency. That's going to lead into our panel on cryptocurrency. I'm doing really brief introductions because you have the full bios in your packet. And rather than me reading that, I'm going to turn it over to Arif. Arif, thank you for being here with us.
Yeah, thank you so much. And I think the first thing that struck me was just how beautiful the weather is and the people in California. So it's, I think, like it's really here. Would some of you put up slides?
We have a clicker someplace. Right there. Yeah.
Fantastic. So most people are absolutely curious about what's going on central bank digital currencies. They are, as I would point out in the slide, probably more than 100 central banks across the world busy on central bank digital currency. And the question that people are asking is, why? What are you thinking about? What are the drivers? What are the motives? How are you thinking about the design of this particular digital currency? And what could the implications of that be? Would it change our world as we know it in terms of monetary policy, financial stability, banking intermediation, etc.? And over the next 10 or 15 minutes, Jerry tells me I'm quite relaxed. I could talk you through a study that we did that unpacks for about 6 countries in close conversation with them, digging behind the scenes, their thinking on central bank digital currency. So here we go. As I point out, that there are more than 100 countries at the moment looking at central bank digital currencies. And what's interesting about this is that it's not just clustered in one particular region. You see that there's a multitude of regions across the globe, both advanced economies as well as developing economies looking at central bank digital currencies. So, because our membership is large, we have 190 members. Our members are constantly asking us, what can we learn, what can we take out from the work that's been done across the globe? And we went into the study sometime late last year and done around with it. And we talked to these 6 countries. We talked to the Bahamas, and you know that they were probably one of the leading central banks to put out the central bank digital currency, the Bahamian dollar. Standalone project. Canada was leading the lead on something called Project Jasper. They've gone through a number of iterations. As I would point out for you, there's now a large pilot going on for a number of years. ECU, Sweden, and of course Uruguay, and put their pilot a few years ago. So why? What is it that's prompting some of the countries to look at central bank digital currencies? So in the Bahamas, of course, as you would know, getting cash around to the islands is not easy. It's cumbersome. They're also prone to have natural disasters, and there were these concerns around misuse of money for illicit activity. So Bahama has been one of those countries most interested in looking at central bank digital currencies. The next project that we looked at was, of course, China. And it might be surprising. Why would you think of a digital currency when you have such a high volume of mobile payments to Alipay and Tencent? But of course, There's also financial inclusion challenges. A large part of a sizable part of the population still is reliant on cash. And of course, given this plethora of mobile payments, the central bank thinks about what does this mean to have all your digital payments in the hands of the private sector. If we turn to Uruguay, the case is very different. Rival for Uruguay was looking at deepening financial inclusion. A large mass of the population is excluded. Then, of course, if you turn to Canada, it was about what happens, how do you prepare for the world where we will be completely cashless. And the central bank there wants to understand very much their role in this digital universe, in the cashless universe. And of course, Sweden, the oldest central bank, there too, you know, you go to Sweden, you would see that the ability to make payments is largely digital. You can send payments in a matter of seconds. And again, the big question is what would happen if you are completely in the hands of private sector for payments. So we pick these countries because they have different stages, as you can see, and some are still in the evaluation phase, like Canada, thinking about both retail CBDC. You can conceptualize that as digital cash issued by the central bank, but they're also thinking about wholesale CBDC, transactions for the securities markets, the capital markets, and how to think of improvements there. Is it possible to have a bond or a security settled in real time, T+0, as opposed to today's world where it might be delayed settlement over a number of days? And could you automate some of these processes? The back office process could be building the rules into the money and have programmable money. Sweden, of course, was triggered by a government inquiry, and they're still in the proof of concept, thinking very deeply about the legal aspects and the regulatory and compliance aspects of CBDC. China has 260 million users at present in a pilot across many provinces. The ECPU were in a pilot very similar to Uruguay and ongoing. In the Bahamas, we know are live, but of course, the challenges related to adoption has been quite significant. And that's an interesting area of work. Why is it that you could have access to a safe, seemingly risk-free asset? Why would they not be adopted? So what are the drivers? And here you would see that we put out a number of drivers. Financial inclusion, of course, deepening access to the payment system, improving the efficiency of your payment system, increasing the cost of transactions, wouldn't that be nice? Improving the speed of transactions between parties, strengthening financial integrity, of course. Many of these payment systems are built on new architecture, distributed ledger technology, as an example, which could strengthen the resilience of the payment system. And then, of course, sometimes, as I will point out just now, some countries, very few, think about issuing central bank currencies in order to protect their sovereignty, keep their money safe from things, as you point out, Jay, like crypto assets, and of course, deepening competition. So where do these different countries stand? What are the drivers? And you will see that the reasons are quite mixed. The largest set of reasons is often around efficiency of payment systems, resilience of payment systems. But across, you will see that there's a number of countries that tick almost all the boxes, like China. So the question then is, what is the architecture? And I'll very quickly go through three conceptual models. The first one is what we call unilateral CBDC. This is a central bank issuing directly to the public. You do not need to go through an intermediary, a bank or a fintech firm or any other entity. And the question is, why would a central bank do it? What would the benefits be? Would there be significant decreases in costs? Second model is what we call intermediated CBDC. This is a model that partners with banks, with fintech firms, brings them into the fold in terms of issuing these particular assets. And then, of course, there's one that's called synthetic CBDC, issued by the central bank, but backed to use as reserves for the means of others to issue other forms of assets. So you would have heard of a company called Finality. They have a sub-ledger account with Bank of England. They back up their issuance wholesale tokens with these CBDCs, but they issue their own form of wholesale banking. And which model predominates? It's the intermediated CBDC. That's the one that comes out for almost all the cases. And the reasons for that are pretty straightforward. Central banks are not geared to deal with the public for many, many reasons. Taking them on in terms of consumers, dealing with financial integrity, AML, CFT related issues, and then just knowing how retail payments needs to be structured, marketed, and work. This is not the domain of central banks, and we see for a number of models that that is the second model that predominates. So where in the value chain then do you see the central bank play a strong role versus private sector? So we've broken this up. Into a number of pieces of the value chain. So the liability, of course, the issuance of the CBDC is for each of these models only issued by the central bank. And that makes a lot of sense. And the reason for that is you want to make sure that if you issue $10, then there's only $10 in the network. For each of these central banks, this is what we see. The second is the validation. And this is the mechanism during the processing of the transactions. How do you ensure that the transactions are processed, finalized, settled? And we see here that there's a mixture between public and private sector. But when you look at the right-hand side, you see very quickly that private sector starts to become the predominant entity to issue wallets, manage the distribution of the CBDC, and manage the customer interface with the general public. But there are two features that stand out from all of these pilots that we got into. The first is zero interest rates. There are no interest rates on this particular instrument. And the reason for that is that, as you see in the previous slides, that the predominant reason for issuing these assets is for payment purposes. It is not for the management of monetary policy. And then there are limits that are applied at different levels. And I'll talk through this very quickly. So you will see that for many of these countries, there are trade-offs between these different policy goals. There's a trade-off between bringing more and more people into the payment system from a financial inclusion perspective. But of course, there's a trade-off between that and ensuring financial stability. Imagine for a second that you have an instrument that is very cheap, very fast, very effective, issued by the central bank. Would you still keep your funds in a bank account, in a savings account, etc., or would you prefer to move that to the central bank? And how does the central bank then think about this trade-off between bringing people into the payment system whilst protecting and safeguarding financial stability? And at the same time, to use another example, how do you do that by bringing more and more people, especially for emerging market economies, into the payments network, whilst making sure that the requirements to enter that network are low? As an example, I come from South Africa. Many people do not have access to identity documents or documents that prove where they reside. How do you allow for those people to come into the payments network whilst at the same time safeguarding financial integrity, etc.? So the way that these central banks have thought about doing this, almost in all cases, is by using tiered wallets. You can come in, your requirements will be very low if you do not have, let's say, a document that proves your residency, and you will get a tiered wallet that allows you to transact for, let's say, $200. But as you decide to transact for deeper and a variety of different use cases, the limits will increase. So I'll conclude, Jenny, by saying, what does it take? We've seen across the central bank that it takes deep capacity to build this. There's a number of open questions that range from the type of business model that will be put out there. many legal issues, thinking about how to go into production. And then, of course, what we learn from all of this is that there are a few principles that are quite important, but there's no one size that fits all. We'll talk about that more in the panel. And of course, we're beginning to help many countries in our technical assistance. There are about 50 at the moment that we're providing expertise to. Thanks, Jay.
Thank you. The second part of this, we're going to have a conversation about central bank digital currency because I have a lot of questions, and I suspect you do as well. So my first question, I mean, this was fascinating and I learned a lot from it, but suppose the Federal Reserve adopts central bank digital currency for the dollar. Now today, when I go out shopping or go to a restaurant, I pull out a credit card. And then at the end of the month, Citibank or whomever it is contacts my bank and it's set up on automatic payment and it's paid directly from my bank. How does that change, if at all?
Right, fantastic, Jay. So it could change. So you go to your bank at the end of the month, and you've set up your, let's say, direct debits or direct credits, etc., and you deal directly with your bank. How will this change, Jay? So what's fascinating about central bank digital currencies, I think, is the ability to have programmable money. So you could set up your transactions in advance to say, hey, Arif, $300 every month for attending a conference in LA.
Oh no, is there a limit to that?
For me, no. Would be realistic? I suspect the answer to that would be yes. But let me take this to that. I think the reasons why central banks want to issue a central bank digital currency is still an open question. What are the policy drivers? And why is the central bank better placed to do this than commercial banks? Would this disintermediate banking deposits? And what would the impact of that be? Would it have an impact on the credit market as you lose a stable source of finance as a set of commercial banks? And is that what central banks want? I doubt that. So I think in short, Jerry, that perhaps some things would change if it's issued, but the influence in itself, I think, still has many open questions.
And my second question comes from my travels in China. And as you pointed out, there are tens of millions of people in China who are using digital currency. And in those places, it's often the case that you can't use a credit card.
Right.
You can't use cash.
Yeah.
And if you don't have a Chinese bank account, you can't pay for anything.
Right.
And so that is potentially a serious interruption in international trade and international tourism. And you pointed out some of the issues in South Africa with folks who don't have the proper or designated documentation. What are the issues there, or is that another impediment to central bank digital currency that might keep it from actually happening?
Meaning not to have particular instruments that allow you to access.
Right, so you can imagine, well, you had the Bahamas there.
Right.
So you can imagine you can only use Bahamian currency and only digital currency when you're a tourist.
I see.
But somehow you've got to go through these costs, which may include establishing an account in a Bahamian bank.
Right.
That's a country that's heavily dependent on tourists. What happens there?
Excellent. So let me use the example of China as best as I understand it. So during the Olympics, Jenny was attending the games in China. And the only instrument that was accepted was the ECNY, the central bank digital currency. How would you get it? Would you need to go to a bank and open an account? And how would you transfer funds into this particular wallet? My understanding is it was very seamless. You download an app, it picks up your geolocator, it knows that you are in a particular province of China, you do an automated upload of your image, and you load up your Visa or MasterCard in order to move funds into the wallet. Once you're out, you can transact within seconds. When you leave, the funds automatically go back into your Visa and MasterCard. So pretty seamless, the way we understand it in terms of how you could acquire the wallet when you're traveling. So for tourists, it should be a breeze, depending on how the design is set up. If it's very intuitive, very seamless, the opportunity is there to use everybody.
And that opens the question, why when you arrive in Beijing Capital Airport, you can go to the exchange your dollars for renminbi, and you're up and running. Which one has less cost, right?
Right. So it's probably which one has less cost, which one has greater convenience, which one allows you rewards over time. Right. So one of the things we pick up is the ability to couple other transaction sets and not just payment transaction sets. So a friend of mine was saying, he was in a rugby game, got this message from one of the providers and said, I see you're in the game at the moment. We note that you do not have insurance for your cell phone. Would you like to have insurance covered during the game? Insurance on demand. And that's because not just of having access to, let's say, digital currency, but the ability to have data that's then linked to your profile.
So let's turn to Gresham's law, right? Where bad money drives out good money. In the U.S., we've had, you think about the dollar is the dollar is the dollar. But we've had multiple currencies in the past, including the greenbacks that sold at a discount. Is this going to be competing currencies within the country?
Well, I would think yes, from the perspective of thinking of it as central bank digital currencies, which is then issued by the central bank, it's certainly a liability of the central bank. Even if you have these intermediaries that I described, like a commercial bank, the liability still sits with the central bank. I almost think of it as like cash, except in digital form. That the cash, even when you draw it out of the ATM, you may have gotten it from Citibank, but the liability is still of the central bank. So yes, I would think of it as a competing set of money. The trick, I think, is the trade-off that I described. How does the central bank think about ensuring that the current two-tiered banking model structure still remains in place, introduces healthy competition from a payment system perspective, but doesn't disintermediate or disrupt the banking sector from a financial stability.
So we've been talking a lot about inflation today. Let's turn to a country with actually a lot of inflation, Argentina.
Right.
Suppose the US has central bank digital currency, so your currency is on the phone with an app. Why wouldn't Argentinians just go to using US dollar and drive the Argentine peso out of existence?
I suppose there are two reasons that may not happen. The first is the way that the US would set up central bank digital currencies. Would it be accessible to the Argentinian population? That's a fundamental question in design. And the second is, would you have providers within the Argentinian network who take on your pesos and give you, intermediate the digital currency? I know I'm making it simple, but could that be the case? We see that now with stablecoins, right? People hold on to stablecoins privately issued when you have cases of high inflation. But for central bank digital currencies, I would think differently. I would think that there's a set of principles that have been put down by the G7, and one of them is do no harm. So how do you design this to ensure that currency substitution in other countries are limited?
But isn't it the case that the large countries, So, speaking of the EU, UK, US, China, who want to have their currencies as being the international currency and gain seigniorage from it, would not really want to restrict that currency from being used outside of their borders.
I suppose it depends again, Jerry. So what is the policy driver? And how do you think about it, within the context of international reserves, a currency for trading across the globe? How do you think about that?
So that leads to the last question that I have. And then we'll see if we have a couple of questions from the audience, which is how, if this were to occur, and I'm gathering from your presentation and your answers that that's still an open question, how long before we would see central bank digital currency in a big way, not in the Bahamas, but in the US or the EU, or Canada, countries that really have been studying it in a serious way. What is the timeline, or is there a timeline?
I think there is a timeline, Jerry, but I almost steer it again and say, I think, in my own personal view, the biggest use case for central bank digital currencies is for cross-border payments. We know how slow, opaque, costly these cross-border payments can be for both business transactions as well as for, let's say, remittances for migrant workers, etc. And I think that there's lots of work that's going on there. There's the CBDC project between a number of central banks called Multiple CBDC by Thailand, Hong Kong, UAE, China, and so on. And there's lots of progress there in terms of demonstrating that there could be real value for cross-border transactions. So I think we'll see it here. Cross-border transactions is probably the first use case that we'll see in the medium term. In terms of retail CBDC, digital cash, I think it's really dependent on the context within each jurisdiction. What would happen now? 261 million users in China. Would we see the shift towards CBDC there, ECNY, versus Value Pay and WeChat Pay? I'm unsure. And the reason why I'm unsure is that the value proposition that you have from these super apps is incredible. You can do, it's more than just making a payment, right? It's booking your ride. In one app, it's visiting the dentist. So it's a rate. So CBDC will have to compete with those value propositions. It has to offer at least a minimum, a minimum product that matches what's in the market. So in terms of timing, I think again it's more longer term, and what that is, I don't know.
So maybe an interesting idea that might not ever happen. So we have questions from the audience. Yes.
So the current financial intermediate system is this central bank issue this monetary base, and through the banking's fractional reserve banking system, we had this money multiplier, and then we create this money supply M1 and M2. So how does this CBDC impact this kind of current system?
So let me repeat the question. So the current system is the central bank creates a monetary base, which then the banks, through the money multiplier, increases the supply of money in the country and facilitates transactions. How does that work with central bank digital currency?
Well, I think if the replacement of particular payment instruments by CBDC, let me use some examples. If it's just a replacement of cash, then what you described remains exactly as it is, right? If it's a replacement of banking deposits, I think we then start to see the impact that you described, right? Banks having to source funding liabilities, from perhaps the money markets, etc. And what would that then do for credit intermediation? Would we even see, transactions in the money markets shift? And if that's the case, I think your scenario would have a larger impact on the multiplier. But again, it's dependent on the design. I think of CBDC with greatness.
Okay.
So when I hear the word currency, I think of two functions. One is a store of value, and the second is a means of transaction. And Jerry has already indicated that most of our transactions are digital now, either because of credit card or Venmo or PayPal, which is direct from me to you. So it doesn't seem like crypto is offering anything new with regard to means of transaction. And the critical issue is whether it's a store of value. That's sort of what William was asking. You think that private market has clearly demonstrated the store of value isn't done very well with crypto. But is it your view that the store of value will work well when it's issued by monetary authorities?
Depending on the credibility of the monetary policy framework. It's the same liability. So I think it's dependent on that. If you have poor regime, poor institutions, poor monetary policy framework, then issuing a central bank digital currency isn't going to change. That's the starting point. Robust macroeconomic policies, monetary policies is the first line of design, if I could put it that way.
So if you're in Argentina, maybe not. If you're the US, maybe so. David. Did you have a question?
No, but I can ask a question. I mean, so the Federal Reserve's proposal was about having some digital currency where it would be a liability on the Fed's balance sheet, not at the local financial institution, community financial institution, wholesale financial institution. So obviously large disruptor. What ethical research has been done in this area about the effects downstream and elimination of credit markets and financial institutions?
Well, I think there's a lot that's been researched on this. And the conclusions are often, those two pieces that I very quickly pointed out that, zero interest rate, we want to make sure that as you put out this particular instrument, you're not competing with deposits unless you want to discipline the market, right? If you start to increase interest rates, then I think the likelihood of seeing shifts from the deposit base to CBDC might be larger. In terms of crisis, in times of crisis, that might be even more prominent. You might see rapid runs, from deposit base to CBDC. So I think there's lots of work that's happened in that space under what you're calling ethical. I would just phrase it differently and say the financial stability implications are top of mind for central banks as they think about central bank digital currencies.
Well, I guess follow-up question, but when you talk about like the China example that you gave, the ethical implications, like we have a robust privacy act in California, and so you think about the privacy and the consumer data, and then ultimately that could have downstream factors, compensation or something to the consumer for sharing that data, but in this case it's forced. So has that been discussed as far as ethical implications on privacy and
absolutely. I think the data protection frameworks are quite fundamental. It's a significant part of the design. How do you ensure that the data that is captured is private and secure, and that even if you have it as a central bank or in inverted commas government, you ensure the protection of that data. The data though is where the biggest benefits could be for consumers, right? But how to manage that data, how to make sure that you use it only on consent of the consumer. In many frameworks, the right to forget and disconnect from that data should still lie with the consumer. But those are fundamental aspects of the design.
And so that may be the largest hurdle to the adoption of central bank digital currency, but non-central bank digital currency is in existence today. So let's turn to that, and let me invite our panelists up. And we'll talk about cryptocurrency, which is specifically designed not to be governmental. Okay, so we have two additional panelists here. And what I want to do is start with, again, a very brief introduction, and then we will move on to a discussion amongst our panelists and with you all. And so we get the questions that I have out. Okay, we're ready to go. And we're going to begin on my immediate right. We have David Wax. David is Senior Director leading EY's Strategy and Transactions Digital Asset Solution Team. That doesn't really fit on a business card. It's a long title.
It's all on its own.
In this role, David has spent the past 2 years aiding in the delivery of various digital asset engagements, including commercial due diligence, market entry strategy, product strategies, and operational risk and control design efforts. And please, for the bios of our distinguished speakers, look at their bios, but let's just dive in. And so we talked about the why of central bank digital currency, but what about cryptocurrency? What was missing in the financial environment that led to the development of this new asset class? And what's needed to allow this asset class to kind of cross the chasm of adoption?
Sure. So thanks for the question. Thanks for the invite. So I think it's really important to define cryptocurrency real quick, right? So when we're talking about it right now, and I'll do it a certain way because I think it's more fun. So let's strip out CBDC. Let's not talk about that. Happy to talk about it later. Talk about it. Let's strip out digital representation of either physical or existing financial asset. Also an interesting topic. Happy to talk about it. That's a question about T0 and liquidity and other things. Then what are we left with? We're left with base payment systems with a Bitcoin, Ethereum, Poly, right? All the sort of base layer transactions that are used for payments within those blockchains and or staking security within those blockchains and return. And we're left with utility and governance tokens, so Unicom, Aave, tokens that are, I won't get into whether the security's not, but represent forms of ownership rights in certain ways of these smart contracts. So if we limit our scope there, because it's more fun to have this answer then basically we have to go back to the past to predict the future and talk about the past. Right? So if we go back to the past, it's really important to understand Bitcoin is the past. 2009 is what was the invention. And that was created to remove intermediaries, right, from the need for centralization and intermediaries to the idea that you said, the store value of the transaction. That was its purpose. You can read the white paper and fade it a little bit, but give or take, that's its purpose. Really important to understand. That's what this thing was built to do. It wasn't built to increase transaction speed. It wasn't built to get to T+0. It was built to do that, right? That's its use case, right? So if we then sort of, pull that, forward and we say, okay, that was Bitcoin. And then you say, okay, what about Ethereum? What about smart contracts? What about that? Fair enough, innovation on top of Bitcoin, but really that's just the same thing. That's just adding logic, right, to now the store value transaction smart contract, right? And then it's adding a whole bunch of other capabilities with governance tokens, right, in terms of voting and things like that, right? So at the end of the day, what it really means is that it's the whole concept of it is to try and remove centralization and remove the need for intermediaries in this transaction, right? And so as I look forward to try and now go from the past to the future, right, and think about, okay, what does that mean? So to me, there's going to be a push and a pull. Actually, I was really impressed by your analysis. I was watching it. And the push part is going to be in terms of the future of cryptocurrency is going to be the level of trust that we have in central banking, right? It was created because we lost that trust. Satoshi lost that, or a group of people who were called Satoshi lost that trust in 2008, right? And it will, and so that's why they created this technology. And so if we continue to lose trust, if there's a massive recession, you guys fall wrong, or that you go off the Volcker curve and whatever happens, probably people will lose trust and probably demand for this currency will increase, right? And just before I get into the full part, the other thing to understand, really important to understand, this is not going away, and I can prove it, I can predict it, because as of this morning, people were still willing to pay $16,900 for a Bitcoin and $1,200 for an Ethereum. After FTX's collapse, after all the fraud, after all the smart contract stealing, after all of this stuff, right? People are still willing to pay that because there is a group of people who are interested in having non-centralized currency for whatever reason, many reasons around the globe. We can get into that. And then the last piece, I'll turn it to more questions about people, is really the whole part of this. And I get into what you were talking about a little bit. The wallet and the experience of this is terrible. Straight up terrible, right? Because its use case wasn't that. It wasn't to solve a better user experience. It was to remove the centralized entity. And so on the pull side, whether it is wallets like MetaMask or Coinbase wallet, whether it is more sophisticated firms like JP Morgan and others, more entrenched firm, that's going to be the other side of this. Right? You can get the push, right? We can have a terrible recession. We can have a government that no one believes in. We can have all that push. But without the pull there as well, like you have to use this stuff without being a programmer like myself, then you won't have it. So you need both. My answer to what you cross the path. Does that make any sense?
Sure, so let me turn to our third panelist, and I promised Nikki that I would not try to pronounce anything in Portuguese with a bad Spanish accent. Our third panelist is Nicole Discant, and Nikki has 20 years of practical experience, currently serves as global head of legal and compliance at Hashdex, which is the largest LATM crypto investment advisor. And prior to that, she had her own legal firm in Brazil, years and years, a decade of experience in the legal landscape internationally. And so let's turn to that. There's a lot of talk about regulation of cryptocurrency. But as David described, the whole idea was to get government out of it. Now government's kind of coming back into that. What does that look like? What is the landscape today as we think about this across borders?
Hello, everyone. Is it working?
Yeah.
Such a pleasure to be here. Thank you so much for the invitation, Jerry and Leo. I'm very happy to be back in the university and this beautiful day. So I'm very happy. Thank you so much. Thank you, my fellow panelists too. Well, first let me say that I completely agree with David and Eric's vision. I think by now we can all agree that Bitcoin has failed to be this peer-to-peer payment method that would rescind the intermediary role and the trust role in the payment infrastructure. I think the crypto infrastructure, as much as it was originally thought, the philosophy was to be very decentralized by nature, it ended up being very centralized. So in the hands of a few players called the VASP, the virtual asset service providers. I'm mainly talking about the exchanges. They call it exchanges, but there are more brokers than exchanges, right? But there's no central counterparty and DVP. So let's think about the VASP again. So exchange, OTCs, custodians, wallets. These guys, the service providers, very few players dominated this market, and unregulated, unsupervised. Unfortunately, their lack of controls and risk management, and of course greedy. So we're now facing the whole market, facing the effects of their greediness, and because it's a very immature and new market, all these factors are affecting the good actors too. So, for example, hashtags. How can we survive in an environment like this? So since the beginning, we actively look for regulated providers. So some of these providers go to, for example, New York Financial Authority. The BIT license is a very strong license. So Coinbase, for example, is regulated. One of their entities is regulated. We have a lot of other examples in Singapore, Hong Kong, Japan, of regulated entities providing the services. So before investing in trading in an exchange like this, we actively look for the license, for the whole group. We conduct a very robust due diligence. So Leo yesterday was talking to me and asking, how can we present this intermediary role and still be comfortable putting our digital assets in the hands of this provider? And I told them, doing due diligence, the same thing we do for banks and we do for brokers. So we have, a due diligence robust list that we look for the whole group, or if it's a clean shop, if there's any sanction against this provider, the whole policy and procedure, business continuity plan, cybersecurity policy. So all the diligence that you normally do in the TradFi, the traditional financial market, we do the same thing for the digital assets provider that we work with. So, so I think my first takeaway here to summarize this is C5, the centralized providers need regulation, ASAP. And not only regulation, supervision and enforcement too. Otherwise, I think the lack of trust will increase. It's impossible to think more after this FTX event. So I think we are, but I totally agree with David that still we have the blockchain is much more than the Bitcoin. And all the, and we can talk a little bit about DeFi as well, the decentralized finance, the protocols that are completely open source, permissionless and smart contracts that are auto executable. And they are not suffering with this price. Of course, they have their own problems, the user experience, and the lack of a human that you can talk and say, hey, listen, I forgot my password. So some of the people are still looking for CeFi, and that's why we came in this centralized environment for crypto. But the DeFi solution are proving itself very interesting for a collateral management perspective. DVP, the delivery versus payment that we cannot find in the centralization crypto asset world, but in DeFi we have some projects, and some projects already mixing and matching the DeFi's benefits with which is a good technology with controls, which are the permissionable networks that we are studying some projects. So for example, I'm part of the innovation lab in Brazil with the Brazilian Central Bank and the Brazilian SEC. And we are studying a very nice use case with our commercial banks being the validators of this network using DeFi technology, but with AML, know your client control. So the banks are validators, and the banks, each one of the banks will have its own stable coin that will work in this network, and hopefully this will be, I'm very bullish of this solution because I think we can have the benefits of having, everything tokenized and everything in digital, but with controls that we cannot present in the completely DeFi world.
This is for the whole panel.
I'm sorry about that.
Opacity is one of the characteristics of cryptocurrency, the ability to, for example, evade capital controls if you want to move money across borders. Whether they are mild capital controls or to the informational ones, or strict capital controls. So opacity seems to be one of the characteristics that that cryptocurrency attempts to solve. When you have regulation, the whole idea of regulation is to eliminate in some way that opacity, whether it's to the user or to the regulator. What does that mean for the future demand of this kind of digital asset?
Yeah, no, I think it's a very interesting topic, Jerry, and I think the whole industry is kind of trying to figure this out. And of course, the regulatory arbitrage that exists in the TradFi and exists as a weapon that people use. For example, in the beginning of Bitcoin, people used to make a lot of money just buying Bitcoin in the US and selling in Japan. So it's the same thing with regulation, right? If you remember this time, unfortunately, I wasn't into crypto back then, but I heard some of my friends make huge amount of dollars. But in the regulatory side, it's kind of the same thing. So people try to look and see where is the best place for them to trade. So for example, we do the reverse thing. We actually look for where is the more robust regulation to trade. But of course, some what we call pirates. They do business all over the world and they are based in a country that there's no regulation. I won't cite names, but I think you can think about what the biggest exchanges that do this kind of stuff. So what I think we are coming right now after, especially after FTX and Celsius and all those insolvency cases that we just had this year, we're coming together for more regulation around the globe. So each country is studying, as you mentioned, like there's some, I think, 100 central banks for the CBDC. A lot of people study vast regulations. Brazil just passed last week, regulation for vast. So, but I take your point that it's local, and again we will have an issue of internationalization. Crypto has no borders. But I think the importance of the international regulatory bodies like OECD, FATF, the Financial Action International Court, the World Economic Forum, the BIS, the Bank of International Bank of Settlements, IOSCO, which is the SEC of the SEC they coordinate. So all of these are bodies. They are thinking together and issuing reports and papers about the risks and how to mitigate. And I think that that's going to be very important for us. And I think a good example of a regulation that tried playing this level to playing the level of this field is MICA in Europe, that is trying to put all the state members in the same position to avoid arbitrage between the countries. And I think Europe, as they did in GDPR, they are trying to settle an example. It's a very robust piece of regulation, much more than all of the best. So we try to regulate each category of tokens, so utility, payment, e-money, which is the stable coins. So they're with different levels of regulation. So I think it's a good example what they are trying to do in Europe. And everyone that want to trade digital assets in Europe will have to follow this in 2024. So we are now in this period for adoption, which will take a lot of work for people that want to comply with this rule. So I think probably this will be a good example for the rest of the world to try to follow.
Go ahead.
Just real quick on opacity, because I think it's important to understand. The transactions are not opaque, right? So if you're a person who likes to track transactions, this is much easier than any other form of currency that I'm aware of personally. Right? It is globally trackable. You told me your public address, I can find every transaction you've ever done in less than 10 seconds. The opacity comes in the use. Right, so the wallets and the fact that they are opaque because that's how it was designed. And so there are a number of entities, bodies, technology companies, even DeFi with Aave and what it's doing, that are trying to solve that. Right. So it's really, to me, opaque is opacity is really about KYC and not about the actual following of the transaction. It's actually, when you're talking most FBI agents or others, it's much easier to follow the trail with this than any other. They actually enjoy it. What I discussed with them.
So there is a narrative that the cryptocurrency is used to move both illegal money and to get around capital controls. But if you can track it so easily, then why would it be tracked?
Because you can do it without signing up into a bank. Right. So I can go get a wallet, I can download MetaMask, I can go do it, I can go hit up Uniswap, and I can go trade this stuff all around the world without ever disclosing any information on myself or who I am or my entity. I can do that today. And there's no other place you can do that except for cash or gold or commodities or other.
So the transaction can be traced, but not necessarily the owner.
That's right.
Transaction.
In those systems. In other systems, they have to go through AML, KYC to get that.
So if you have more regulation, does that go away? Does that really reduce the demand for this kind of asset? Or are there other characteristics that make cryptocurrency an important new asset class?
Well, when
Let me weigh in. So I hear David in terms of the desire to not have intermediaries, ability to transact, track, and trace, and I hear the case for stronger regulation. I go back to Nick's point about the essence of money. Right? If you want to have a great small value and a medium of exchange, then surely regulation is what gets you there. Opacity is not going to get you there, right? And we know that for some of the crypto assets, you can have techniques, and it all sounds fancy, mixers and tumblers and so on, to ensure that the anonymity remains. So whereas you can track the transaction, in those cases it's even difficult, right? You can track the transaction, but to link it back to the individual is extremely difficult. My sense of it is that regulations come. We see that in the example of the MiCA and all the bodies that change, it's coming. And I think if we take the macro view, that if we want to ensure that the impact on the international monetary system, as these transactions become more and more present, more and more prolific, we have to make sure that the international monetary system stays stable and sound. And therefore, I would argue that opacity is not the name of the game. Transparency is the name of the game, whilst protecting individuals' privacy. But let me pause.
I just want to add that to answer your question of if you introduce centralization and regulation, would you lose the asset class, right? And so I think the answer is we'll see, right? So it was designed, right, to remove intermediaries, while introducing regulation will introduce intermediaries in some way, shape, or form. And it was designed to be anonymous, right? And so obviously regulation will end that as well. So its original design intent will be destroyed. So the question is, are there other facets of this technology that are strong enough to overcome that disruption, right? And the argument today is maybe, but the ones who make the argument to yes is sort of your T0 settlement piece, right? You can actually settle, right, these things faster. The lack of friction between global payments, which is really just a removal of intermediaries, okay? So it's very good at that. Okay? And then, some other things around programmability and controls and all that kind of stuff in the smart contract. So that's yet to be seen. Like that's the interesting question. When regulation comes, I agree, well, and it removes those initial use cases, is it then still a technology that's better than the decentralized databases that we have today? Like, and that's what all people who are spending all the money researching this are trying to figure out.
And I guess follow-on would be, suppose you have that regulation. Not every country wants to follow that. You can think of maybe Cayman Islands and others like mine. Do you have a new cryptocurrency starting in these locations with that kind of characteristic, the one that's lost with regulation?
Competitive. But personally, I don't think you would see a centralized government cryptocurrency standing up, stuff like that.
Right.
I think you would see these existing platforms that are decentralized, like Bitcoin and Ethereum, as the competitor to centralization, right? Which is really what they are. They're literally competitors to centralized. Yeah. Right? And so we need to go that way. With that all to see. I think there's a lot of cool.
And Reed, you talked about as these cryptocurrencies become more prevalent, the IMF is thinking about how do you meet your charter to smooth out fluctuations in international capital markets. What are the issues there?
Thank you. I just want to go back to something I pointed out. So sustainability, I buy what you're saying earlier on about the potential other products to emerge, right? Maybe crypto, I don't know, 2.0, 3.0, whatever one wants to call it. But the ability to see tokenized assets like property or mining rights or carbon credits, we've never had that before. So the potential to move beyond just money lies there. And I think we see more and more innovation happen in that space, tokenized assets, the ability to fractionalize. I love to own art, expensive art, but the ability to buy it now, for pieces of it would make a lot of sense. Going back to the question on how do we see the overarching framework in the IMF, I'm happy to say that we're very close as the IMF to produce a paper that we call the 9 elements of highly effective crypto policies. And you can think of these 9 elements across 3 dimensions. So often when authorities, the ones that you mentioned, are thinking about crypto rightly, so we go for the middle layer, I'll describe it now, all about regulation, licensing, the VASPs and the exchanges and the wallet providers and so on. As the IMF, we're forced to take a step back and say, well, how do we think about this more holistically? So the first dimension I'll capture very briefly is really about macro considerations. How do you safeguard monetary policy and sovereignty? How do you ensure you don't issue crypto as legal tender and granted official currency? Right? That's element 1. And then how do you think about the impact on fiscal policy and tax laws and so on? And how do you think about, as you mentioned, capital flows and ensuring that there's safeguards for capital flow management? That's tier 1, if I call it. Tier 2 would then be about the legal framework, regulatory framework, licensing, and the collaboration, with domestic regulators. That's tier 2. And tier 3 would then be about how do you address the extraterritorial nature of crypto assets. And Cayman Islands is an example that you use. How do you negotiate with the other regulators to create what you've got for WICA? The consistent, I think they call it level playing, right? That's tier 3, including the IMF together with other standard-setting bodies monitoring the international monetary system for changes in global reserves, impact on currency substitution, impact on capital flows. And then the last piece to the puzzle, which is the 9th element, is how do we not only as a collective community just have what I would call a defensive strategy? How do you also start thinking about what David was mentioning, leveraging the technology, right, for other use cases to come? And I'll position again quickly that I think that the 9th element is really about strengthening cross-border payments. And it doesn't matter what it is, whether it's stable coins or CBDCs or some other form, like interlinking faster payment systems. This is where the magic lies, I think, in cross-border. So that's how we're thinking about it across these 3 dimensions, the 9 elements. It should be out in the next 2 months or so. Yeah.
Okay, look forward to that. Do we have questions? Yes.
As a banker, this is all great. As a banker, but the amount of fraud that occurs in the banking system today is epic. Our clients, pretty much every single week, we have one of our clients have some sort of fraud. There are people sitting out there in foreign countries spending all day long figuring out how to get into our database, companies' databases, and they ACH money out, they wire money out, they take over accounts literally every week. How is cryptocurrency going to prevent that? I mean, if it's all online, there are going to be people sitting in North Korea, in a room trying to figure out how they get into the database and steal everything that's in it.
I have one for you. You guys want to start, please? So we have to separate it. I think in today's world, when you use, what's needed to know the DeFi or smart contracts, it has a lot of problems and it doesn't solve tremendously the problem that you're talking about. Where I think cryptocurrencies does, or the blockchain technology along with wallets, does solve the account hacking problem really well. It is almost impossible to hack. I mean, it is impossible to steal someone's private key. That's true. But that and that type of cyber and or physical theft is possible, but there's a lot of ways to protect against it. So I think that strengthens or can be strengthened with this technology. I think the hacking into the basically exchange, you can think about it that way, is not fully worked out at all, and I think regulation and some more sophistication will help that out a lot, right? And I think they can solve it. I don't know if that helps with your answer, but that's how
I don't know, I don't believe it. frankly. I mean,
Yeah.
to be honest, you have the amount of fraud and the sophistication of the hacks, and the information that they get, it's unbelievable. I mean, I can tell you stories for hours, about companies who have had their email, the CEO hacked, and they send an email to the CFO and says, you know, wire $1 million to this account from them, buying real estate somewhere, and it's perfect. It's absolutely perfect.
To that, because I think there's a difference between the fraud, the on-chain fraud and out-of-chain. So this kind of fraud, I think, is like the phishing part and the cryptocurrencies, and it happens a lot as well, but it's mostly like human wrongdoing and not like hacking the blockchain itself. Right? Yeah. So it's kind of the same in terms of like people doing this kind of fraud. And in crypto, with digital currencies, at least in Brazil and Latin America, we see it a lot. For example, our rule, the law that we just passed, brings a specific crime that is like just going against this type of cryptocurrencies, pyramids, right? Pyramids. And we didn't need this crime because we had like a generical fraud regulation that would cover that, but because it's so, you know, high on that type of crime, we put like this specific crime for people to see and try to, you know, disincentivize and maybe prevent the lowering defenses against it, but it's there because of this giant town in Brazil.
So that's to prevent something like FTX.
If you consider that like a Ponzi scheme, yes, let's see, I agree, it seems like it was fraud. But I'm talking more about this kind of stuff that you mentioned, like people trying to steal money, like saying that it's like a regulated business and put your money here, then you're gonna receive X, Y, Z in terms of interest rate, and it's just like a Ponzi scheme.
We have other questions.
Yeah, I heard the word token, I think, said that, that brings to my mind these NFTs that have had incredible sales, pieces of art, because they are associated with blockchain records of transactions. And so I'm wondering whether that market will really cast any shadow on the Bitcoin, or one in three things: NFTs, bean babies, and tulips. You have to worry about any of that.
I only buy digital tulips. A lot. So yes, of course, there has been a bubble and speculation going on in all of this, right? But, I think there's a book called Boom and Bust out there. A little fun, great book, by the way. It hits with all the bubble stuff, you know, starting with people know. But look, there was a especially in a thesis, massive bubble around speculation, which was driven by an immense amount of liquidity and a lot of people having a lot of time on their hands because they had nothing to do because you were sitting at home staring at this. 100%. It happened, obviously. But underneath all this are sort of interesting innovations that again are because of the technology and the communication levels that we have now, we need to understand, right? There was no internet in 1994, there was no social media in 2000, right? The speed at which this technology is able to grow is unbelievably fast, and sometimes it grows faster than its use case. And that's what happened, right? But the question of can you take an NFT and build a viable use case? I can come up with a few, right? They're just very different than me, right? Like Ticketmaster and what they're doing, Yellow Heart, what they're doing around ticket sales. Really interesting use case for NFTs, right? These concepts of soul-bound NFTs, right? This idea that you can never trade, you can never move it, right? It's just yours and yours, and it's like almost like a social security card, if you will. We do a lot of really interesting things for that. So it just needs time to work itself out because of the speed of technology and communication. These things just move beyond themselves, in my opinion. And so interesting technology, interesting thing. Yes, there was a bubble. We'll see what utility comes out next. So,
And we have two other questions over here. Go ahead, first.
Thanks. I'm a bit afield as a demographer, but kind of reflecting on the title of the panel, Future of Cryptocurrencies. I'm curious, David in particular, you kind of led off by saying that, these aren't going away and pointed to the $16,900 price of Bitcoin as an evidence that all of these other, individual entities, actors are still interested. But then you drew a sharp distinction between the original use cases that are a little bit more geared toward non-regulation and anonymity, which are generally going away, and the new, yet to be really discovered and taken advantage of use cases such as cross-border or whatever. So is the incentive of these, every individual actor and everything in your view, these kind of new incipient use cases and the potential windfall from that, or is it something else?
in terms of the future? Yeah. I think it sort of starts to hit equilibrium pretty soon. So there are plenty of use cases and plenty of people who want decentralized currency for various reasons. We can just use a simple one. You're in a country where you cannot trust your government, they can literally steal your money, right? There are cases of that, and Bitcoin is a use case for that, right? It's just not a universal problem. Universal problem is when you ask 10 people around the globe randomly, 9 out of them say, I really need that. Right? The internet is a universal problem. It's not that, and it will hit equilibrium, and it will flow based on that push. How much do we trust our centralized governments, banks, other people? How much do we not, right? In terms of the new use cases, it just comes down to, are those advantages that blockchain has really advantageous, right? So I talked with a client of ours about US equities, right, and using those on a blockchain. This is a big infrastructure player. And their point of view is right now, no advantage. It's unbelievably efficient. Right, I mean, again, there are inefficiencies and I understand supposed to do all that stuff, right? But the answer is no. But in the case of private credit, private equity, the liquid markets that don't have, strong issuance properties, they don't have great transparency, there is no liquidity on the secondary market, literally no liquidity. Yeah, I think it's kind of tremendous, right? So I think it's asset class by asset class, and then eventually the technology may evolve to take over really efficient stuff.
Yeah.
And I'm also very bullish on the tokenization of real assets and the ability to share small pieces that today is what we cannot buy because it's inefficient, it's cost effective. You buy a fraction of an Apple share and put as collateral of a fraction of a real estate asset in New York. So that's we are not there yet, but I think we will be there by some point. I don't have a crystal ball here, but maybe the 3 or 5 years. Today, the tokenization is not very, some of projects that started because, there are still in sandboxes, so there are some legal issues too. But the study and the technology behind, I'm really bullish on that. What about you guys?
Yeah, similarly, I know the topic is cryptocurrencies, but I think of the power of the technology and as David was saying, the speed at which it's evolving. And for cross-border payments in particular, and not linked to CBDCs, I think I'll just call it multilateral platforms is potentially what I think will emerge in this space. So the ability to to see central bank and commercial bank money tokenized and easily transferred across borders within multilateral platforms that solves liquidity issues, contractual issues, greater transparency. I think we'll see access to finance.
Just to give an example of countries where you don't trust the government with issuing money, Myanmar, formerly Burma, 5 times since gaining independence, has completely trashed the currency by saying to their population, you have this currency, it's no longer honored. We're going to issue new currency, but we're not going to trade in the old currency. So in Myanmar, people rely on Norwegian telecom if they want a store of value. And we have our next question.
Yeah, this is a sort of a policy question here. if labeling, a phenomenon is important to give it both legitimacy and credibility, is the word crypto the appropriate, title for this currency? Because I looked up the definition of crypto and it said, first of all, cryptography. But the second definition, said it's about a person having secret allegiance to political creed. So I'm wondering if you were to rename this phenomenon, what would you call
I'll give you a hashtag for this.
The prevailing industry term for that is digital assets. That is what most large banks who are working in this area now refer to this area, for the exact reason. They want to distance themselves from that name, now they want to distance themselves from other, sort of issues that are going on. The digital assets is the way that they're referring to it, which is the decent name.
So, Nikki and Reed, David, thank you so much for being here. Learned how little I know in this area, but now I have the basis to go and more.
We all know very little.
Thank you very much. This is going to break our program for this morning to before we leave. Two announcements. One is that our next conference is in March, and we're going to be looking at the change in the business of healthcare post-COVID. If you remember back on my charts of the sectors that have been growing, healthcare and social services was one of the fastest sectors. There's a lot of really interesting innovations there that have implications for insurance and as well as for the delivery of medical care. And then the second and final announcement is, again, we could not do these programs without our sponsors, and I want to quickly thank them once again because they're so important for us and our the research and programs that we do at the Anderson Forecast. Our principal sponsor is RSM today. Our platinum sponsors, the law firm of Allen Atkins, Cafe Bank, Clark Construction, Leap Development, and University Credit Union. And then page. At the gold level, our sponsors are Avenue Insight and Analytics, Bank of California, California Banking Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half and United Airlines. At the silver level, Hackley Dinwiddie, Scotworth North America, Union Bank, the private bank, and Valley Bank. At the bronze level, Dove Value Creation, EY, HBR, Economy Bank, InstaWork, and Marsh McClellan Agency. Our Bruin sponsor today is Herbert Kawasaki Wealth Investment and Management, and our academic sponsors, UCLA Extension. Thank you so much for being here, both our in-person audience and our virtual audience, and we will see you in March.